Two reasons why many people do not like dividend stocks, and you can see it everywhere online in YouTube or Twitter. Why many people steer away from dividend stocks, okay, and they go towards tech stocks, growth stocks. Okay, very different fundamentals. And in the earlier video, I shared that why I like dividend stocks, because dividend stocks provide me cash flow, it keeps our companies honest, and it's very stable, right? So these are one of the three most powerful points of dividend stocks. But why people steer away from dividend stocks? It depends what kind of investors they are. Dividend stocks tend to be very stable, very flat. You know, you're basically investing for cash flow. And when you invest for cash flow, you get maybe 3, 4, 5, up to 10% per year, right? So it's flat and kind of boring. It's great for people like me who want stability and who wants a passive income lifestyle, because I don't want 1 year 10%, 1 year like 0% or minus 50%. And people who tend to go to growth stocks, they hate dividend stocks because of the reason it's too stable, okay, it's too boring. Growth stocks always have very sexy stories. They'll be like, we're going to grow 1,000%. We're going to go 500%. They have a lot of sexy stories, sexy narratives, and sexy goals and predictions. And I'm not saying it's that, you know, you should go to one camp or the other camp. It's like dividend camp versus the tech camp or growth camp. No! That's a lie. You can have both. You can have 80% in your dividend stocks, like what I do. 80% of my money goes into dividend stocks. 20% goes into like more high risk, high returns. To me, growth and tech stocks do fall into high risk, high returns. Okay? So it's not either or. You can be either or if you want. Or you can have both, right? So in this case, I'll highlight to you the most powerful thing about the growth stocks. Okay, why people don't like dividend stocks? Because growth stocks is more sexy. There's more growth potential. There's more growth narrative. That's why when you go online, when you see the story of Amazon, started from $1 and all the way up to like, you know, $1,000. Then people are like, oh my gosh, 1,000% return, 1,000x return. That's what 100,000% return, and it's wonderful. Okay, let me go pull out a quick one. Let me see. What's the growth like for Amazon? Amazon growth rate over the years. Okay, right now. Okay, Amazon is not $1,000. Sorry, obviously I don't look at the growth stocks, right? Okay, it started off in $9.97 at 10 cents and went as high as $178. That's a really beautiful story. $178 divided by 10 cents. Let's go with calculator, right? $178 divided by 10 cents, 0.1. I was right. 1,780x, which is like when you times 100, it's 178,000%. It's very sexy. So you should look for emerging markets like Amazon. 20%, 15% of your investment can go into this higher risk stuff. You must know that not every company is an Amazon. Not every company is a Facebook or a Netflix or Google. Sometimes it's a hit, sometimes it's a miss. For every 10 or 100 companies like this, maybe there's 95 that fail, right? So it depends what kind of investor you are, what kind of growth you want. Okay, both are okay. Depends what kind of timeline and what kind of lifestyle you're looking at. For me, I decided that I want more cash flow because I want to have a regular income coming in, so I can live off it. And if there's extra dividends, I can reinvest into dividend stocks and or growth stocks or crypto, right? So both are okay, right? So the stories for growth stocks are always very sexy, much more than dividend stocks that are flat. But growth stocks really suffer during the time of crisis. Growth stocks, the Bitcoin, cryptocurrency, tend to work very well when money is cheap, when debt is cheap. So when you realize when COVID happened, so it hit a height of $178 because everybody was working from home, or many people were working from home. So there's a lot of ordering online. So the price went up significantly. However, right now when inflation is so high, the government's trying to control the amount of inflation, pushing the interest higher, right? Yes. And then money gets more expensive. People move away because money is too expensive to invest. So the price from $170 dropped all the way down to $93. That's close to 50% drop. So when the market punishes this kind of growth stocks during a downtime. So it depends on your gameplay. You got to dive in a little bit deeper. Both are great. And I'm excited if you're going to start on your investment journey. But know what your philosophy is. Know what you're going in for. The way I do it is because cash flow is very important to me. It keeps me going and keeps me investing and buying and spending stuff. Whereas you want to buy Amazon, what people do is that when the price goes up, they take a bit money out. The price goes up, take a bit money out. But if the price goes down, do you still take money out? No. So that's the variable that I don't like as a cash flow investor. Okay? So that's all I have for you today. Take care.